send them a screenshot. But bear in mind that there will be a video that will be recorded, put up on my YouTube channel, and also sent to everyone at Discord. Everyone can hear me, great, okay. Progress. How was everyone's day? Please do, if you've benefited from my analysis, and if I've made you any money, I'll send you my bank account details. No, I'm joking. All I ask is if you give me a review, or in general the FX Street analysis and the service at Trustpilot. I've put the link in the chat. What that does is it not only promotes the service, obviously, and I get to feel very satisfied with good feedback. But what it does is it encourages I can't speak, the company FX Street to to really get behind this service, and with that we can grow the services that we're giving to you, and just all in all, give you more than what we're giving at the moment. I mean, I've got ideas for a number of projects which would really benefit you guys, but I really need your backing, and therefore, please give us a review. Thank you very, very much. More things to come, I promise. I'm working extremely hard this end, extra hours, weekends, and so forth, to get good stuff out to you. Okay, so let's just get into the charts then. I will share my screen if I haven't already. Share your screen. Share your screen, share your screen. There we go. And we're going to start with yields. At the end of the day, that was the driver. Let's go through the highlights of the day, which you can see there potentially. So it was CPI day, and initially the knee jerk was, well, the Fed is probably done hiking and they're going to pause, certainly at the next meeting. That's the consensus. But what I have been looking at is a tight labor market. So yes, inflation appears to be stalling. In fact, it posted the smallest back-to-back increase in 2 years. All right, so that is significant. But and also, U.S. jobless claims rose to the highest level in a month. But it is still well within line of a tight labor market. And last Friday's 3.5% unemployment rate is, it's still pointing to inflationary hazards, and the market might be getting a bit ahead of itself. Anyway, we got a turnaround, and we'll get to that in a moment. I mean, Fez Daly says that there's more work to do to get inflation to goal, and the standout to me was the U.S. Treasury stumbling after the 30-year bond auction flags weak demand, and that is inflationary. Now, I've posted a link here. Let me see if I can copy it. I'll put it in the chat. Well worth a read for those that are trying to understand why the dollar rallied today. So Bill Ackman was calling it, and we had the 30-year Treasury auction, which saw very weak demand, and yields shot up. So if we look at what happened with the yields, I'll clean up this chart now. Get rid of that. Don't need that. Don't need this. So that 10-year So there was the 30-year auction, there was the volatility. This here, this line in the sand was broken. So we've gone over this in the education section in Discord, talking about market structure, breakouts, and so forth. So this was a swing high over here that was broken in that auction around about 11 o'clock. Leading up to the auction, we pulled back and then we surged out of this consolidative peak formation giveaway bullish environment. And that caused the eventual rip in the, or tear in the US dollar. And I was talking about it in the audience with you guys in the Discord room. We were looking at this jamming and looking for the breakout over here, which fueled eventually our trade setups that we were looking at the start of the day. So from euro, yeah, there a nice 5-to-1. Gold eventually broke out. Dollar went to the swing high, the swing trade target of, well, through it. We made a high of, so up at 80. So we left 30 pips on the table, but that's fine. And that was a 4-hour trade. Stocks eventually flipped, didn't they? Peak formation, big slide. There was a trade in there as well, 7R, catching the short opportunity and so forth. Unfortunately for me, it didn't work out because I made a doo-doo and actually I bought back my position by mistake. I'm trying to scale out, not to worry, and did well elsewhere. So that's essentially the day. We called that at the start of the day. We were looking for this US dollar to essentially do what it did, right? So at the start of, at the end of yesterday, we were talking about sell-off and looking to buy low. At the start of the day, we were discussing this, and we were looking for the bid, and I can show you that we were looking at that there. If you see that, that's a screenshot of the Watchlist New York CPI in line, tight US labor market, and the looking for the dollar rally, which eventually came off. So, did anyone go over the video that I put out, the CPI video, which is on the YouTube channel here? In here, the CPI video, I introduce the phenomenon, which is the 3-day cycle. And that was essentially what we traded today. We traded these 3-day cycles. Day 3, looking for the correction of the shorts. So that's what we got in the US dollar. And that was applied, therefore, across the board on other currency pairs and the stock market. So what I'll do later today is I'll do what I did yesterday for CPI for you guys, so that we drill this in. I'll put it in the education section, and we'll go over this board of assets, currencies, stocks, and so forth. And I'll apply the 3-day cycle methodology to here, and we'll create our watch list for London and for New York traders. Okay, and hopefully you'll start to see how this can be applied in your trading if you want to go by this methodology using the weekly template that I've also put in the education section for you, which I use, which might help you for in essentially analyzing the charts in the way that I do, and setting yourself up to identify where the most probable high probability trade setups are going to come in your trading session for the following day. And that's essentially what I'm going to do for you. So, do we have any questions? Do you want me to look at any of these currency pairs? Do you want to give some foresights, some analysis ahead of Asia, London, and New York Friday? Yeah, nice. I like what you pointed out there, and you pointed that out early today with the euro. We were looking for that test of the week low. We're talking about the non-farm payrolls range. And that's essentially what we were trading in. So that's well spotted. Sounds good. Just want to know about gold, sterling yen. Right, sterling yen. We'll start there. Sterling yen. Where are you? Up here. Right. So we talked about the sterling yen opportunity, which paid off. So where are we now? Let's clean up the chart entirely. Start anew. So it was day 2. Today was day 2 in the 3-day cycle, which makes tomorrow day 3. However, we've come up into the highs of the week. We've broken those. We've come back on the inside, but we're yet to test yesterday's highs. So we're still okay to label this as day 3 for tomorrow. Day 3, we are expecting a pullback into the trend. So this will be tomorrow, Friday. So what we've got here is a whole bunch of people in the money celebrating as this rallies through last week's highs. Therefore, this must be going up. You've got higher time frame traders all piling into this. Higher time frame traders. So higher time frame traders and their sell stops. So that's low hanging fruit for us, right? So we want to be targeting these stops, and we want to be looking for a short. So we'll put that over here. Our trend line here. Trying to connect the dots. We've got another trend line in here. Now, have we broken? No, we haven't. So according to this 50-minute chart, we are still front side of the trend. Let me explain that for those that aren't following the education that I put out in the Discord, but you've got the higher high, and you've got a swing low, you've got structure over here. So this higher high originated from down here. That might look different on other broker platforms. This low, I'm not sure. Pretty aggressive stuff going on there. Let's have a look and see if we can find the same on other brokers. Y, like Pepperstone. Yeah, so it's the same. Okay. All right. So what we're looking for is a break of 183. Call it 103.22. That will cement the thesis for a move lower. That's on the 5-minute chart that we're looking at here. Now, on this 5-minute chart, the structure was broken up here. Okay. Head and shoulders, structure was broken, bang, sell. Stop loss, ride it all the way. Lovely. And what can we expect at the moment? Well, will we get a pullback? Quite possibly. Peak formation low. Will we be seeing a pullback? So we haven't got much to go by other than that high up here. 183.78. Yeah, so 183.78 is really what we need to see broken if we are going to get a pullback to sell high. Got a potentially, that's a potentially strong high. This could be the next high, 183.70. So long as we stay below this area of resistance, we can be looking for structure, bearish structure, potentially a retest of it, failure. Okay, failure. So maybe we're going to ride this trend line up, fail to break those highs, and that will be confirming our bearish thesis for Friday. Does that make sense? So we're looking for a short, wherever it's going to turn out, we don't know, can't really say, but we're currently on the front side of the trend, so bullish until we get a break of structure and short opportunity for the day ahead. Now on the ATR, we can use the ATR as a guide as to what size of a range we might expect. So we've got here on the daily 180-ish, 190 pips. 190 pips. So let's say we're below. So we'll close over here somewhere. Maybe we'll come up a bit further. Okay. Let's say the range is up in here somewhere. What did I say? 190 pips. Let's call it around 200. Let's be optimistic. And that would bring us into this area over here of support, potential demand, responsible for the. Ultimately, this was the low of that rally, of that bullish trend. So we could be targeting towards here, 182 the figure. And today we rose how many pips? 170 pips. Okay, so we might get that on Friday. A sell shorting opportunity. Okay, August supposed to be a boring month, summer holiday and stuff. So far, it's been pretty good to us, hasn't it? Done pretty well this start of this month so far, and there's been plenty of volatility. Sounds good. Just want to know about gold. Gold. Okay. Well, for this, I'm going to start with the dollar. So with the US dollar, we could be in for a pullback and then to rise and then to right. So where are we on day 2? So we're looking for a continuation. So we might get the pullback to come higher. Then again, this candle here is problematic in that respect. Perhaps we're just going to push on up in the US dollar. So if that is the case, okay, so let's have two scenarios. If we push on up, then we expect the continuation of gold as highlighted in all of this week, really. We've been talking about this downtrend and prospects of a continuation to test this low 1902. So if the dollar continues to rise and if yields remain stubbornly high, still on the increase, then gold is going to continue lower. If we get a pullback in these yields from, say, this resistance area, then in doing so, the dollar would usually, presumably, follow suit, and we'll get that pullback. If we go to the 4-hour chart, we can draw a Fibonacci on this. So presuming that this is going to continue up for the meantime, and we've got 20 minutes until the close of this bear candle, of this bullish candle. If this closes flat as a doji, then we can be expecting a pullback, potentially an engulfment to the downside for the next 4-hour candle, but we might get a blip higher. So let's target 102.28, and then our pullback could come into let's put that one over there. Could come back in to test 102 and below around this 38.2 and breakout area on the lower time frames. And if that's the case, then you'd expect to see gold stall on the downside and move up into shorts. And on the 15-minute chart, we can look to see if there's a deceleration. So we're sort of bumping along here. We're trying to break out. Potentially we're going to head into this support area, and that might be the last ditch effort by the bears before we see the correction. Okay, so that's my best bet, is that we are going to continue sliding and start to peter out, maybe break structure for a pullback again into that resistance, trendline resistance. Okay, so now going back to the dollar, then what are we expecting for the day ahead? That's right, we're expecting a day 2 continuation to the upside. So pull back and then maybe head higher towards 102.50 as a round number through 102.40 potentially. Okay, so we've got you there on the gold then. I've given a couple of scenarios. Let's go to the Aussie, and then we'll go to Swiss. AUD, USD, AUD. There we are. AUD, USD. Again, another fantastic trade, as discussed in today's watch list ahead of the US CPI. Now, what do we got here? So if we look at this on a 3-day cycle basis, this is going to be day one because it broke the week's high convincingly. Well, not so convincingly because it didn't close, not even on a 5-minute basis, above this week's high, which is over here. So I'll mark that on the chart. Didn't get a close on a 5-minute here. Interesting. Okay. We're right back inside. Did we break yesterday's low? Yes, we did. Well, we've got shorts in the market. We have got shorts in the market. It's not obvious to see, but I'm just building a thesis here for Friday, so bear with me while my brain ticks over a little bit. This is a tricky one, right? Hold on. Right, day one, day two, day three. Day one, day two, day three. Let's turn to day one. So we could expect a continuation of day two of the 3-day cycle with a second day of shorts in the market. So where's the close here? So we're going to come into Friday near enough at Wednesday's closing level. So we failed on the upside. Bears are in control. Now, we could have a continuation, complete sell-off. But that would only occur if this US dollar that we've looked at can continue higher without a pullback. I think it can go a bit higher, and then we're going to have a scenario where we're breaking last week's lows. We're going to have breakout traders chasing that move only to get trapped. So I think what we could see is a continuation to the downside, depending on how Tokyo opens in the stock market, which would be over here. But I think we can have a continuation, lower, pull back on the inside as the dollar fades, a retest of these highs perhaps, and then we're coming into London, and London might want to get on the side of the trend, and that could continue all day in London perhaps, and we're moving at that point into stops below these lows. What does this look like in fact on a higher time frame? Let's go to the daily chart. Daily chart. Alright, so we've come down, we've pulled back, and this is the continuation. So if we want to put a target on this, well, obviously we've got these lows down here, what we can do also is measure the correction. So we've got that bearish impulse, pullback, we measure that correction. We've got this area down here as a target, 64.87, 64.54. So I'll just mark those up. Okay, so we're using that Fibonacci correction measurement as a target for in here. And how does that look over here? Well, it lines up almost perfectly with that low. And this could eventuate all in the same day on Friday. We have a very strong sell-off, depending on how the dollar continues to trade between now and London, really. So we'll use Asia. We'll see how Asia range set up. For traders in London, you can lean against Asia, what's happening in Asia, reverse into the longs, buy into the shorts, check out the structure, the highs and lows, and so forth. And then we can use Asia and the new London to see what we're looking like for New York. And we'll look at that in the morning before we open up, or around the New York Open, 7 a.m., ahead of the window of opportunity, let's call it, around that Wall Street Open. So the closer we get to Wall Street Open and the further away we move from it, but interestingly enough, look, it's the window of opportunity, but interestingly enough, as I take my lunch every day this week, the market's gone berserk. So just bear that of note as well. So that's round about 1 o'clock New York. We're getting big moves. We're seeing big moves around lunchtime. All right, so that is the Aussie for you guys. And we could go to dollar Swiss. Dollar Swiss is coiling between resistance and this support. And we were talking about the short. This is markings from yesterday and this morning, I believe. And I think that's exactly what we got before the rebound. So we've got the short. Okay, that was in London. Okay, we just got the rebound in New York. Okay, so where is the money? It's the first thing to ask yourself. Where's the money? It's down here. So what we're looking for, again, it really depends on what the US dollar is going to do. If we're going to get this continuation in the US dollar, then that's obviously positive for dollar Swiss. We can run higher, and we've got 87.80 as a near-term target, and then stops above for a test of 88, and a push through to 88, maybe 88.20 for argument's sake. So these equal highs. You've got shorts in the market, shorts in the market, shorts in the market, and all of these shorts are under pressure here. So they may already be coming out of their trades. You'll have fresh money coming in, anticipating with the break of 87.50. I believe a lot of the big algorithms are set up with these round numbers. So triggering those higher time frame traders in as well, the machines and so forth. So maybe we'll get that push up before the eventual sell-off, or we're going to get this correction before the move up. Now, in terms of the day count, go to my 3-day cycle template, and let's have a look here. So we've got prospects here of a first red day scenario. Having said that, we didn't really come up into highs and then come down low. So this is not really a first red day scenario. Nevertheless, I would be on the side of caution in trying to chase this move up, and I'd be much rather looking for an opportunity to sell. We're coming up into resistance. I'm not saying that we can't continue higher. I'm just advocating not to chase when we're already quite high up in this box. You know, sometimes that rule can go against you. It did for me earlier today, but it also keeps me out of trouble more often than not. So I don't like to chase the move. I'd rather be buying down here in anticipation of that. And this is how the day count can help us. So let's establish where we are in the week. So this is Monday over here. We had a failed breakout of Monday's highs. So this classifies as a day that we can start our day count. So that's day one. Day two, and lo and behold, day three was the sell-off into those longs, and then we were buying as the dollar picked up the bid. Now, if this is day three, this by default will turn to day one in the day count. Considering we've got this peak formation down here, we can be in anticipation of a continuation, in fact. So that goes against what I'm looking for, but that's the rule. So day one, and we are now heading over to day two of that 3-day cycle, which could be set up to go long. So what we might find is that coming down into these longs, and then the continuation trade. We could see that in London, but then I'd be looking for potentially, if we have Asia down low, London rising, and then a continuation up in heading into the New York Open. If we're up high, then we've got 3 sessions of rise there, and that could be giving us the opportunity for a sell-off, a machine gun sell-off, breaking structure all the way down to wrap up the week, potentially inside of the week's range, rather than being up high. S&P. So we got the flip in the S&P. We moved into low-hanging fruit, and we've settled down low in the day's range. And I'm just going to clear this chart entirely and start fresh. So we're down at last week's lows. 1, 2, 3 pushes into these lows here. Now, there are 2 things that can come out of this really, or 3, but we're in anticipation of movement, volatility, so we can continue. So we've got to pull back and then a continuation, or we can trap these breakout traders and move up into Thursday's shorts. So we can have a breakout that fails, so a breakout, pullback, continuation, or a breakout, pullback, and reversal. So again, this will depend on risk sentiment and the US dollar. So the market is digesting the data. It was already priced in, but there are 2 minds around as to whether the Fed is on the cusp of pausing again, whether it will be a hawkish pause. We do have a tight labor market. All of those things are being run through the machines, the algos, and the quant desks, and so forth. And it may not be until tomorrow that we get the follow-through of all of what's being considered. And we've got data on the calendar tomorrow as well, let's not forget. Red news in the UK. So we'll be looking for data out of Europe and comparing it in contrast to that of the US, and we're taking into consideration the divergence theme between the Federal Reserve, Bank of England, RBA, China, and deflation, so forth, Bank of Japan, and then we come up into the US session, and we'll be looking to the Michigan sentiment and PPI producer prices. These could all be triggers for whatever the market's going to do tomorrow. It could be a catalyst to either help it along the way of the expected flow of the market, or in contrast to anything that we're talking about here in the dollar in terms of the day count, and that the prospects of a continuation higher. If we get that continuation higher, then the S&P, presumably on the back of poor risk sentiment, then the S&P would be expected to continue lower. My suggestions, Ross. Most people miss your trade setups. Not the ones that attend these meetings. They did. I mean, we had uh, people today taking the setups and doing quite well. But whenever you have a trade setup signals, you probably paste the images on this chart or type it out, giving us entry price, stop loss, and take profit. I hope I'm not asking too much. Thank you, sir, for all you do. Well, thank you very much for your comments. Well, so essentially, I'm not giving a signal service. I'm not giving entry prices, exits. I'm giving you analysis, and I'd much because when it comes to trading, I can give you my exact setup, and you'll enter at a completely different price, and you'll come out at a completely different price. You'll move your stop loss, you'll trail it, you'll come out of, you'll add to the position, you'll do all sorts of different things. So I'm not really here to advocate signals for day trading. Day trading is hectic. It's what's the word I'm looking for? It's intense. So trying to give a trade signal as well as trading myself and doing all the analysis for you guys, it's a lot. And I'm but what I have been talking about is a swing trading signal service. Um, that can be done at a much more relaxed pace, and we can do the analysis in the afternoons at the end of the day, and that's fine. We can do it in these meetings because you're only going to have a handful of swing trading setups per week. I mean, you might only have one or two. I mean, the dollar yen was one I gave at the start of this week, I believe it was, or was it Friday? I believe it was Monday, and that paid out to anyone that followed that. So I think that would be the direction I'd prefer to go rather than day trading signals. It's more complex. I'd much rather give you the setup, the analysis ahead of time, and then for you to run away with that and do what you wish with it. Um, I mean, they don't work out 100% of the time. I can give you analysis and say, well, the dollar's going to go up tomorrow, and then it comes crashing down, and then you'll be pointing your fingers at me. But for a signal service, for it to work out for someone, you need to stick with it. My opinion of signal service is people try it without the understanding of the system itself, um, and not knowing the win rate um, that the system has. I could give you signals. Say I could give you 10 signals, and let's say it's a 50% win rate, right? And the first 5 signals I give you lose, and you get fed up and cancel your subscription with us and give us a bad review on Trustpilot. And then the next 5 signals that I give all do very well. And, unfortunately, you didn't stick around long enough. So you've got all of those risks with that. So I'm not really keen on the day trading signals, but swing trading signals is something I'm going to progress to. It's actually something that we're already working on, and it'd be exciting to get that running for you guys. So we've done the gold analysis already. I'm about to post this watch list on YouTube, and I'll post it in the Discord. And there'll be another breakdown later on in Asia that will be there for you in Discord as well, and on my YouTube, when I'm going to go through these pairs extensively with the day count and marking up the charts for our expectations for tomorrow. So there we are. Dollar yen. We can look at that. Dollar yen. Right, dollar yen. At the start of the day, if you recall, we said that it's likely to be a day 2 continuation trade. Okay, that was our thesis, targeting our swing target of 144 spot 50. That was on the trade that we had set up at the beginning of the week. However, we noted that we already had a lot of longs in the market, so we wouldn't be surprised if we got a long squeeze. right? So we're looking for the long squeeze. Well, we got both. We got the long squeeze and we got the continuation. Now, what I was also mentioning is that this now is going to be day 3 on Friday, and we'll be looking for the sell-off. And I've said we could get a big sell-off. So we could. So if this dollar sells off, then, or regardless, I mean, even if the dollar just moves up, comes back and consolidates, then we could still see some movement in dollar yen, more so than euro dollar, because the Dixie is geared mostly towards the euro. I can't remember what percentage. I'll look it up. DXY basket yen percentage. Blah, blah, blah. Bear with me. Right, well, the euro is almost 60% weighted, and the yen is only about 14%. So even if the Dixie doesn't sell off dramatically, we can still see a sell-off in the yen. So we're looking for the yen to strengthen. And we've got breakout traders here that broke last week's highs. So we could end up trapping them up high, breaking the trend line into low hanging fruit of other higher time frame traders sell stops, and that could cause a sort of cascade of stops being triggered and like a waterfall machine gun fire sell off into stops, low hanging fruit over here and over here. All right, what are we looking at here? Let's look at this Fibonacci. Let's do the Fibonacci measurement on this rally. So I'm going to clean up this chart entirely. It's too messy. So we've got a market that's come up into resistance. So that's bearish for us to note. Expect to pull back from resistance. That's not to say that it can't pop higher. Of course it can. It can come up to 145, 145.20 and then come off. But let's measure this impulse. The impulse, there you go. It could come all the way up into 145.35. So this is our target range for the upside. So we're already in there. It could come higher, but then we'll be looking for the sell-off. And then the sell-off, we can measure that. Put that over to the left. And if we measure this impulse at its current level, right, we could be coming down into, say, a 38.2, 50% mean reversion. Those two there line up at the current highs, line up with this presumed supporting area. All right, and then if we look at the ATR, now when the yen runs, it flies. It can really move. So I wouldn't take the ATR as anything strict, but we've got 130 pips on an average that this market will move on any given day. So if we just take it from the highs, 130 pips. Here, and that marries up with the 38.2. We've also got a price imbalance, so this market shot up, it's pulling up orders, so we could be coming down to fill all those, and we could base over here in the high 143.70s, or if this is just going to continue, then we can do a measured move from whatever consolidation we might get up high on, let's say, the hourly chart. So if this market now just starts to consolidate and range, let's say within a a range like this, perhaps, maybe into these lows, into these highs over here. Then we could do a measurement, and we might say, well, I think this can fall further. We can measure from there to say the lows. And we might say it might do 150% of the range, taking us into the 50%, or 200% of the range, taking us down to the 61.8 and 142.80. All right, so that would marry up with what we talked about earlier, the low-hanging fruit. Stops below here for an extended target. Okay, so that's dollar yen. So the dollar is strong, but the yields took off, Cynthia. Yields rallied. We talked about that at the beginning of the meeting today. 30-year auction. There was very little demand, for bonds, which caused the yields to rally, and that's inflationary. And I've put a link in. I'm going to send you it again. Well worth a read. This guy here, Bill Ackman. Could be the answer to all of your questions with regards to why is the dollar strong. Have a look at that. Just trying to find out. Right, any other questions? Have I missed any pairs? I'm ready to cancel now. What's happened here? Atto Bakari. What you ready to cancel? Anything I can help you with? Let me know. Team Mother can't always hear me. Right, I'm actually sorting out the audio. I'm going to get a microphone so it will cut out the noise on my fan. So I apologise about that for now. This is all in progress. Team Mother, good evening. We've done analysis on the stocks already. Essentially, let me have a quick look again, and then we're going to wrap this up because I want to get on with the videos for you. So the US 30 in the S&P and the Nasdaq are all essentially the same market structure, same influences, same reactions, same market flow. Now, it depends on what this US dollar and risk sentiment is going to do. At this point, I'm in anticipation of continued strength in the US dollar, and we just need a couple of more confirmations out in the market to solidify that thesis. But that would be a weight on the stock market. And if we go out to the daily chart, well, we may head higher to come lower. Can't see any reason why it's just going to pause over here structure-wise. That's the Nasdaq I'm looking at, I think. The US 30. So we're trying to break out lower, aren't we? We've got these head and shoulders in place, break of structure over here, right? So we came up, broke that structure, we've come right back up, and now we're starting to build the case for a sell-off. It's on the daily chart. Just looking at questions here, see if I've missed anything. Okay, yeah, see you tomorrow. My issue is that every preview was about CPI. So it doesn't line up, I'm lost. Okay, well, look, the data that comes out on a daily basis is usually already priced in unless there is a reading that is way outside of consensus. So you've got all these clever hedge fund managers in these quant desks and these big investment banks, Goldman Sachs, they've already traded the news. They use the news to get out their positions, funny enough, when all that liquidity comes in. So what I advocate is leaning against the news after the fact. And today was essentially a classic case, and it just so happens to coincide with that Treasury auction. But you'll see it every time, regardless of there being a Treasury auction or not that favors the US dollar. You'll see these swings. You'll see a knee-jerk reaction and then a complete reverse in contrary to the data. So the approach to trading the data is let the data play out in the market and the volatility to happen. Have your thesis for your directional bias ahead of the data. Great. If the data lines up with that thesis, then fantastic. You can go with it. If it doesn't, then expect that it could turn around. And if you see a setup, then you can take the setup after the news, once the dust has settled. And then you might get the momentum, during your setup on the back of the news. So the volatility of the news is helpful for trading, but I wouldn't want to be positioned ahead of it. I wouldn't want to say, oh, well, that was positive for the dollar, so I'm just going to buy the dollar. I want to see what the market does, and if there are any price action discoveries that eventuate in a setup. When I say price discovery, I mean the volatility. So when that market is bouncing around, that's the market looking for its direction, and it's being driven by orders. So if you've got passive participants that have got their orders in, such as buy limits, sell limits, buy stops, and so forth, the market will hunt that liquidity, and once it's got its liquidity, it's going to go where it wants to go and fulfill the purpose of the market, and that is to fill orders. So if you've got gaps in the market, that's where we're targeting. If you've got a market that's pumped up and left orders behind, like the stock market today did, right? So you can expect the reversal. So I think, have I answered your question there? Ato Bakari. You said your issue is with every preview was about CPI. The preview was about CPI today because that was the main event. Just because it doesn't line up with the market reaction is not something that's in our control. We can only give you a preview of the event, what is expected, and what might happen. But we can't tell you what is going to happen because no one can do that. But what we can is we can trade what we see at the event, up to the event, at the event, and after the event. And if we see an opportunity, well, that's what I'm here for. I'm trying to give you enough analysis for you to be able to act upon. And if it works out, then great. Always manage your risk. Always take responsibility for your risk. And the idea here is to learn from the experts that are in this, that are offering this service. Learn from us, and then take that away, and hopefully you'll develop your skills and become profitable on a consistent basis. No problem for joining late. As I said, there will be a video that I'll put out. Yeah, let's see how we close the week. Exactly. We want to see how we close the week, and then how we're going to set up next week. Katika de Maria Ramos. I don't get how yields have such an influence on the dollar as opposed to CPI and the employment data. It's all about bonds. It's all about interest rates. The market is driven on sentiment around money markets. So the US dollar, people are going to position into the US dollar in anticipation of what economic data is coming out, what political risks are for us, in front of us, and indeed what the central banks are likely to do with monetary policy. So the debt markets, bonds and so forth, interest rates, all of that is critical to the market. So one CPI reading is not telling the whole story, nor is one employment report. It's the build-up of those data points that are factored into the market and priced by very clever people on these big trading desks and investment banks and IMF and all that sort of stuff. So all we're doing as traders is we're looking at the opportunities to catch a movement within the trend and nail and bail, as it were. I'm not trying to predict what's going to happen next year, this year, next month, but we can build a thesis for what might be around the corner and how to trade it if it turns up. Waiting for the dust to settle, give it anything between 7 to 15 minutes. Team Mother. Asking about liquidity in the market. The market runs on liquidity. It's drawn to liquidity. So the market is drawn to orders, to liquidity, to demand and supply. After the day count, the data said dollar would suffer, but price didn't follow the data. After the data came out, the data said dollar would suffer. What do you mean by that? Well, one of our analysts said that the dollar would suffer, perhaps. Look at the Dixie. Look at the hourly chart. The data came out. It was 8:30. What time is it? 8:30 New York. I can't even remember what day is it today. I don't know what day it is. Thursday. Today. $6:30. Yeah, 8:30 my time. Let's have a look on the chart. What did it do? 6:30, 8:30 New York. Let's wait till half an hour. So, on the knee jerk, the dollar suffered. Well, yeah, it did. It dropped to the low of the day. Dropped to 101.37, and it was up at 101. So it dropped 50 pips. Sound only me spaced out like mine. That's my Christian, no problem. Thanks so much. Yeah, great. Love being here. See you tomorrow. Yeah, okay. Potentially, someone might have said that's bearish. Well, it is. It's a bearish factor for the dollar, but it doesn't mean that the dollar is going to uh, sell off just because of one data point. Well, it did sell off and then it bounced back, and that's very typical of news events. So just because the news is fundamentally bearish or bullish for a particular currency does not necessarily mean the currency is going to extensively react to that sentiment. I mean, it can do on the knee jerk, but it can just as well flip as we've seen today. There are more things going on in markets than one data point. And remember, the big guys have already traded the event weeks in advance. They're positioned, they know they've got these quant people that are calculating what non-farm payrolls is going to be in December this year. And they've traded on the back of that. And they get paid millions of dollars when they get it right. So what they do is when the event comes along, they start trading out of it ahead of the event, and they might use the event or the liquidity to come out of their entire position. And that's why you see these big movements, because they're putting billions yards at a time on getting out of their position at a profit or at a loss. Okay, guys, so we'll give it a wrap there. That was a long one, well deserved though. It was a big day, been a big week, been an excellent week for some of you guys. Getting some great feedback. I can congratulate those that are taking away what I'm giving you here on a plate for you to use on your day-to-day trading. Nice to see that people were profitable on the back of it today. Really appreciate the reviews that I've been receiving and that we as FX Street Premium Service have been receiving on Trustpilot. That's very, very helpful and excellent stuff. So I wish you a very good rest of your day, and we look forward to seeing you tomorrow, Friday morning, bright and early. Rise and shine. Let's get this going and close the week strong. All right, let's see if that pans out. Non-farm payrolls range low. Is there to identify liquidity in the market? That's a good question. To identify liquidity in the market. Well, yes. I can't remember. I don't know what it's called. Some people use it. I don't know. I don't use it. I don't know what it's called, but it's essentially captures the orders. So you've got like an order book. If you go and Google that, go and Google order. I don't know what it would be called. Order book, forex, order book, stocks. But on your chart, it will give you the number of contracts at a certain price from passive investors, traders that leave their orders in the market, and it will give you. So essentially, it will tell you, well, there's so many thousands of contracts at this price, and then that's displayed on your chart. So the more orders there are, presumably the market is naturally going to gravitate to those orders, and then come away from that area if the orders are large enough to move the market. Other than that, you can use volume profile on TradingView. So on my chart here, go to indicators, technicals, profiles, and there's a whole library of different volume profiles. You'll have to go and research yourself, but I like to use the fixed range when I'm looking for targets. Let's say, so we're on this Dixie now. Well, let's go to I don't know, S&P, right? So I would look at this range from top to bottom, and if I'm looking for, say, a long, and I want to target, then I'm going to use this volume profile. This volume profile is essentially historic data that shows where most transactions took place. So the thicker, I think these are called volume nodes. The greater the volume node, the more transactions were taking place, and the higher the likelihood that it's going to act as resistance. So you could target, for instance, so if we get through this volume node here, then the market's thinning out, so the price is more likely to gravitate towards the next area of volume, and that could be your target area. Yeah, so that's how I use it. Okay, guys, have a good one. Thank you for being here. Been a pleasure as usual. See you tomorrow. You're welcome. Bye for now.